up 850 points right now. It's an over 5% gain that we're seeing for the Hong Kong market.
Up 4/10. Definitely cooler than expected.
Market clearly reacted to the fact that the core inflation was lower than what was expected.
Big rally is seen in the rupee. It is at now 7-week highs.
250 points higher now on the Nifty.
For India, earnings growth held up better than expected and most people thought.
The healthcare services, it was clearly the fact that occupancy improved. We moved from 60% in the last year to 68%.
Operational metrics this time around have improved, and importantly, the disclosures of the company have improved as well.
The Nifty is holding above 18,300 as we speak.
In terms of inventory, we really made a significant reduction in our inventory from quarter 1 to quarter 2.
It is a 12% margin that M&M has clocked in.
Development Finance Institution is providing America's largest solar manufacturer with up to $500 million in debt financing.
Justice Call has taken very serious objection to the centre essentially taking on names that are sent by the Supreme Court collegium for elevation to the High Court or to the Supreme Court.
We have Nifty up around 300 points.
Well, that was the day so far. You're with us here on a Closing Bell. I'm Prashant. With me, my colleague Reema here in the studios, and Mangalam joining us from the newsroom floor. Mangalam, hi. Welcome on board. Well, things are looking
hi
pretty...
to me also.
I mean, you're next to me. So,
Hello, guys.
all right. Things are looking pretty steady, at least with the Nifty, I have to say. And I think I have to add that caveat that things are looking great for the Nifty. The index moves from last night are extending. So you look at US futures, they're up 0.5%. You look at the dollar, which has kind of corrected a little bit. There is news from China, which seems to be kind of very slowly inching towards kind of some sort of reopening. They've eased their quarantine rules. Chinese stocks are higher. Yields have moved up a little bit. And I think what's happening in China is that the currency is getting pushed higher. And that is putting additional pressure on the dollar, which is not exactly bad news. Hang Seng is up some 7.5%, 8% by close today in terms of trade. I mean, I think follow through later today out of the US will be important to watch, as always. Just one thing, even as the Nifty is doing so much, and the earlier morning highs have been taken out and we are at new highs, the broader market is not showing the same amount of enthusiasm. You look at the mid-cap index, the intraday will come up. That is almost flat. Nothing, 24 points on that index. And the small cap index is also not showing too much enthusiasm at this point. Market breadth is still positive, but it could be better for a 300-point up day on the Nifty. Reema.
Hi, and just some more data points, right? HDFC Bank is contributing 90 points plus to the Nifty up move, and the balance 60 points is coming in from HDFC Limited, which means the two HDFC twins are contributing more than 50% to the up move. Add to that a Reliance Industries and Infosys, and then you've got nearly 80% of the Nifty up move, which is coming courtesy just these four stocks. I'm not even talking about the rest of the IT large cap names like TCS, etc. And you add a few more, and then perhaps all the gains would get covered in that. So in a way, what we're trying to say is that perhaps the gains are fairly concentrated today, which also ties in with the fact that the mid-cap index, after a strong opening, has seen all those gains fizzle out. It's absolutely flat for the mid-cap index as we speak, and all that euphoria has fizzled out when it comes to the mid-cap, index. You spoke about, China reopening and how, things appear to be set in motion on that front. Up until now, the global inflation has also not fully reflected China opening up.
Oh, yeah.
China inflation has been very weak for the month of October, reflecting the weak domestic demand. So once China opens up, demand will go up, but even global inflation is going to, go back up. So that inflation, which we're getting happy about, that perhaps it's coming under control, can rear its ugly head, back once again.
No free lunch, right? There's always some price to pay somewhere, second-order impacts. Absolutely. Mangalam, what are you watching out for?
Well, I'm looking out for two things that may, be a little more ahead of the curve as far as the data points are concerned, and that's usually the money markets. We're wondering what happens in the US tonight. Well, overnight, we did see that crash come by in the dollar index, and that's only continued even now. In fact, when we started out trade, the dollar index was around 108, which of course was lower than the previous levels that we saw. Now, as we speak, it's about 107.5. So that is the, that is a sign that is telling you that maybe there could be some further up move in the US markets. The second thing that I'm looking at is Dow futures, in fact, moments ago it was up around 200 points, and now it's moved around 300 points, 270 points to be precise, on the way up. So today may be a good day for the US, and that is what we'll perhaps watch out for in our markets as well. Rima said, HDFC Twins, Reliance, the IT index, metals, all of them are doing well. Can we have a last hour flourish into the weekend? If that happens, then, it will be even, it will just be the cherry on the cake. But we do have a lot of other things to watch out for on the show today.
Absolutely. Mangalam, you were our go-to person to tell us what are the fun things to do this weekend. So I was hoping that you would throw that in as well. But we'll have that chat perhaps later on. But for now, let's tell our viewers what we've lined up for them on closing bell. HDFC Bank, HDFC Limited are the top two Nifty gainers. What's got the stocks excited? Details on the show. Indian Hotels, on the other hand, is losing in trade despite reporting a strong set of Q2 numbers. What's weighing the stock down? Also on the show today. And chemical stocks like GNFC, Deepak Nitrite and Fine Organic are reacting to their quarterly updates and numbers. Complete fine print coming up on the show. And finally, we'll also be joined by our Alpha Manager for the day, Rahul Bejal of HDFC AMC, to discuss his view on the markets and the top portfolio calls.
Well, how should you position yourself going forward? That's the question, isn't it? So let's get that going. Mitesh Thakur is back with us. Mitesh, good afternoon. This lack of participation, enthusiasm in the mid and small cap space, does that concern you? And what would you do now?
Oh, I think there's one space, Prashant, good afternoon, which is still weak. We had some sell calls on GNFC and Chambal Fertilizers yesterday. I think there are pockets of weakness, but that doesn't concern me because one, it will not affect the Nifty. Two, I think, the Bank Nifty, when the HDFC Twins have a significant weightage, I think both the charts look very good to me. In fact, HDFC Bank was the top call today morning, and HDFC Limited also looks very good. So I think, while there could be some kind of profit booking happening in a couple of mid-cap names, I think the large caps will show a lot of comfort. And with the IT pack joining hands today on the upside, I think we should be clearly trading with a positive bias with focus on the large cap, purely because you are right. I think a couple of mid-caps are showing signs of profit booking and weakness. So I think just shift the focus alongside, just stay with the large cap, the liquid names, and that's how you should proceed. In fact, I have two IT names on my recommendations right now. One of them is Cofor. I think that's sorry. Cofor has given a good breakout today. That's a buy with a stop at about levels of 38.40 for targets of 39.75. And the other one is FSL. Disclaimer, we have some positions over there in the future segment, but that's a buy with a stop at 105.5 and a target of 112 on the upside.
IT higher despite the rupee appreciation or the rupee strength, which is typically negative for the IT companies. But let's talk about the news makers of the day, and that's the HDFC Twins. In fact, they started their up move in yesterday's trade in the second half of the trading session, particularly in the last 1 hour. We saw a big pop on these names, and they've continued with the big move, 6.5% gains. CNBC-TV18 learns that the MSCI inclusion overhang on HDFC Bank may lift. Vivek Iyer is joining in with the details.
Well, that's right. In what was perceived to be quite a bit of a technical overhang as far as, the merger was concerned. And what we're talking about here is actually the treatment that passive indices would give this particular merger. So HDFC Limited and HDFC Bank merger, there was worries about how exactly, a big tracking fund like MSCI would actually treat both of these stocks. So the worry was that, there could be the possibility that, the names would be removed from the index, and post which, once the merger was completed, depending on the foreign headroom available, and then they would be put back into the MSCI index. But now, what's actually happened is that MSCI itself has come out with a circular today, and they've updated new rules to handle corporate events like M&A, which, fits the bill as far as the HDFC Bank merger is concerned. So two things have happened. Number one, the first thing that they've said is they'll immediately consider HDFC Bank as part of the combined entity. And the second thing is that, the foreign room or the foreign headroom clause which was there, that also has been eased. So analysts are now estimating, quant analysts are estimating that the weightage of HDFC in the MSCI index could actually double. And this is something that has led, number one, to analysts believing a significant amount of inflows could come into both of these stocks. And also the entire sell-off that could have happened earlier is now no longer there.
All right, Vivek, take that point. In fact, HDFC Bank has been an underperformer as compared to the Nifty over the last 2 calendar years. This year as well, it was on track to do that. How does it end this year will be extremely crucial to watch. We do have with us Sriram Velayudan, who is the Vice President Alternative Research at IIFL Securities, joining us to discuss more on this. Sriram, as per your initial calculations, if the weight was to double, how much would that mean in terms of incremental flows coming into HDFC Bank? And do you think that, with this, the outperformance or the underperformance of HDFC Bank will get undone?
Hi, good afternoon. So as Vivek pointed out, in one of the important amendments that the index provider did to the methodology document, one of the conditions in case of companies undergoing mergers was there was a requirement in relation to minimum foreign room. Now, as per the updated methodology, the minimum foreign room requirement of 15%. So what the methodology states is, for new constituents, there has to be a minimum foreign room of 15% available for retaining or for inclusion. Now, this requirement is totally taken out. Correct. So that removes a major overhang in terms of a new stock getting retained or getting considered for inclusion in the index. Right. So the immediate overhang is now behind us in case of these names, but still there is some clarity which is required in perspective of what will be the adjustment factor that will be applied for such constituents. Let's say as a process of continuity, if the stock is retained and if the room is greater than 15 and 25, there will be an adjustment factor of 1 that will be applied. And if it dips below 15 and if it's greater than 7.5, adjustment factor of half will be applied. In case of half, the flows will be largely neutral. If in case the adjustment factor ends up being 1, we can end up seeing a decent amount of inflows in the name, almost to the tune of 2.5 billion odd. But still, we need clarity how the treatment would be. But definitely, as you rightly pointed out, the uncertainty and overhang is behind us now.
Sriram, a very basic question. How do they decide this adjustment factor? Because that will determine the inflows, right? At 0.5% adjustment factor, the inflows will be neutral. At 1%, at 1x, you're saying the inflows could be $2.5 billion. How is this decided?
So, Reema, this is purely based on the quantitative framework which the index provider has laid out. So the basic objective of this index, right, is to present a tradable basket of stocks for the foreign investors. This is purely based on the methodology document. This has been the framework over the years.
When will we know what the adjustment factor is?
For that, we will have to wait for some more time, because largely what happens with the global indices is, in case of mergers, the adjustment happens a day prior to the X day. So there isn't still clarity. There is no clarity as such when will the adjustment happen. But largely, going by the rule book, we expect it to happen towards the closure of this event. Though it's better if we wait for clarity, because this is a new amendment.
No, absolutely. The market, though, is not waiting for that clarity, Sriram, is it? How would you read the 6% move? It's very large for these kind of names.
Yes, right, Prashant. So what has happened is, after this amendment, the overhang is now behind us. Because if the stocks would have got removed from the index, that would have led not only to outflows, maybe it would have been out of a very prominent benchmark as well.
Right.
But as I said, now that the overhang is behind us, market is definitely cheering.
All right, we take that.
Amendment.
Yes, we take that point. And since you're with us, another stock which is in focus, and this one is Indian Hotels. It will be included. This list has come in the MSCI India Standard Index effective December 1st. Analysts were expecting about $200 million worth inflows on account of this. What explains the kind of decline that we're seeing? The numbers, there was nothing wrong in that. I mean, does it have anything to do with any sort of announcement with regards to MSCI?
The stock has done up its course. In fact, I will refrain from making any stock-specific comments. Maybe the rationale would be like, the funds that would have prepositioned are using this opportunity to book profits.
Sriram, thank you very much for joining in and have a great weekend. Prakash Diwan is also joining us on the show now to talk about the markets, what we've seen so far. Prakash, you like HDFC Bank, right? It's a bit of a gamble, right? We don't know what MSCI is going to decide as the adjustment factor. But at current levels, would you buy HDFC Bank or Limited?
Good afternoon, Rima. So, the MSCI thing was just a trigger for people who probably always thought HDFC Bank and HDFC Limited and the combined entity would offer value, but there was so much of erosion in terms of positions, and there was so much of dilution in anticipation of one of them giving way to the weightages on the way out. Right? So that was something which people had factored in. But remember, this whole merger process is going to actually fructify sometime in April of next year. So you still have about 5.5, 6 months to go, which means that fundamentals will become center stage, will dominate the narrative rather than just a technical, flow-based buying or selling. And the money that's coming in, mind you, is more ETF money, and that's exactly why weightages have been so important. But I think over a period of time, over the next week or so, people will kind of, market would have digested this change in weightages as and when it happens, and then start deferring it as a trigger. But the fundamentals will come center stage. And what numbers HDFC Limited gave out just a couple of days back tell you that, once the combined entity starts performing, you'll have comments like who says the elephant can't dance, and all of that will start bringing out the salience of this JV. So my sense is more from a fundamental perspective, it offers tremendous risk reward. Whether to buy it today or not is your decision, but I would be a bit patient and wait for a lighter day. Today is too much of exuberance. 5 stocks, rallying the Nifty to all-time highs, towards all-time highs or 52-week highs. But I would definitely wait for a softer opportunity to buy into this.
Prakash, got many more questions for you, but need to slip into a very short break. We'll come back in just a jiffy.
Welcome back. Continues to look good for the market. We have a bunch of mid-cap IT names which are doing well. First Source, for instance, has now moved to the high point of trade, up almost 7%. Most of the gains coming by in just the last few minutes. We have Intellect Design as well, which has moved to the high point of trade. But in an unusual move, it is Indian Hotels, which is down by almost 8%. And this, despite the numbers actually not being too bad. If you just take a look at the way the companies reported their numbers, compare that with the pre-pandemic levels as well. Because year on year, of course, there has been an impact on account of lower base. Pre-pandemic revenues have grown by about 22%. The EBITDA has actually jumped by 76%. And that's telling you that the company has managed to maintain most of the cost cuts that they had taken during the pandemic itself, and that is sustainable. However, if you just look at the way the company's profitability has been boosted, that's on account of strengthening of their balance sheet as well. Finance costs have come in at around 60 odd crores, and this compares with 114 crores that they did same time last year. We spoke with the management today, and this is what they had to say with regards to whatever disappointment, if at all, the street would have had on account of margins. They said there was a one-time adjustment with respect to costs in the second quarter. They should end FY23 with a margin closer to 30%. Q2 is usually the weakest quarter for them. 45% of their revenues come in the first half itself. So assuming 55% comes in the second half, they've done around 2,500 crores in the first half itself. It's not too far to assume that they would do about 5,600 crores in terms of this annual revenue. And over and above all of this, they still believe there is a headroom for 25 to 30% jump in the room rates itself. Interestingly, it was announced that it will be included in the MSCI India Standard effective December 1, where there would be $200 million worth inflows coming in on the counter. But turns out, maybe because of some pre-positioning, we've seen some long unwinding on Indian hotels. Prakash Diwan is still with us. Prakash, I just wanted your thoughts on one, Indian hotels. What do you think explains this sort of 8% down move despite what looked like a decent quarter? And secondly, the narrative for all these new age companies, which is now changing away from growth and going into profitability, and which is why we're seeing big moves on the likes of Zomato, Nykaa, PB Fintech, all of them.
Okay, so Mangalam, let me take this new age companies first, because that's easier to explain. We probably had already started seeing the market anticipate a lot of inflows, a lot of supply in that sense for most of these stock, because of that 1 year lock-in getting over. And as typically happens, markets never give you that kind of a simplistic opportunity. I mean, when everybody is anticipating that, markets never oblige. Things happen much differently and much before that. So anybody who wanted to seek an exit out would have done that. And it's not necessary that most of these investors with the 1 year lock-in getting over are just going to rush out, right? And at the same time, for some of the specific names, you have, let's say, Zomato, case in point, the unit economics have started getting reset tremendously differently from what it used to be when the IPO had come in, and immediately thereafter, because they started charging for a lot of the services which they were not doing earlier. They've reset their entire relationship with a lot of the eateries. So it's a whole new model that is being tweaked into, and then that's exactly why from that bottom that you saw, wherever, I don't know, 45 or wherever, there's been a lot of buying that believes that there could be some sort of a light at the end of the tunnel and not a train coming through the tunnel. So that's where Zomato's already got into a little bit of a positive, hopeful trade. But interestingly, all these names are being debated so much without anybody looking at profitability, except for Zomato, as I said. But some of the other names like PB Fintech and all, they continue to burn cash. The profitability is still not very close, but still there is interest. It's very speculative and driven by hope that things will look up, and there's going to be somebody who will want to buy these stocks at some point. So I think it's best avoided. You would have to look at businesses which are more solid, and there's enough and ample opportunity available there. And let me address that Indian hotel perspective that you had sought. I don't think it's got anything to do with the fundamentals. There probably seems to be a little bit of that iffiness or skittishness around that MSCI inclusion, and that quantum is not as anticipated. And that's why some people will have to kind of look at exits, which they could have been built because of anticipation of this incremental flows. But the fundamentals continue to offer a lot of opportunity to still grow. We've seen that with East India hotels. The same is the case with India hotels. So it's clearly a space which is revving up, and the good times are actually around the corner, with so many countries taking this COVID restrictions out. It's going to increase in two-way traffic from some of these countries as well. So, a lot of them in the Gulf, a lot of them in Southeast Asia. So all that traffic is finally going to translate into better revenues. And we know that the last 2 quarters typically tend to be more promising. So it's a good opportunity for people who don't yet have allocation to the sector to buy into it. But I don't think there's anything on the numbers that's been disappointing.
Zomato charging for things they never used to charge before. Well, that seems to be the name of the game, right? Even Twitter plans to do that eventually in India as well, with an $8 blue tick. So he's quite a maverick. So perhaps he could change the rules for the entire new age tech companies, platform companies, and how they raise money. Interesting times, perhaps. But let's get back to our own markets. We've seen some sharp moves in chemical names like GNFC, Deepak Nitrite, Fine Organic post the Q2 numbers. Sonal is here to tell us more. Sonal?
Thanks a lot for that. Well, for GNFC, it is a weak set, a top-down miss, and that's why a sharp fall on the stock as well. We have seen revenue declining by 4%, EBITDA is down 28%, margins are down by 900 basis points, leading to a profit decline of 16%. Where the company says their fertilizer segment did well, it was aided by higher volumes. However, it was the chemical segment which witnessed realization pressure, and that's why that big fall in margins that we saw. Sales volume reduction also was seen in their chemical segment because of an outage that they saw in the month of July. Fine organic on the flip side, strong set of numbers. It's a second consecutive quarter when the company has really outperformed. Gross margins, they were up 590 basis points. However, they declined 430 basis points on a quarter-on-quarter basis. But overall, revenues up 110%, EBITDA up 91%, margins were up 1100 basis points, and profits were up 73%. Lastly, watching out for Deepak Nitrite, the stock was down 10% yesterday post-results. There's a mild recovery. We spoke to the management today and they explained the reasons as to why the phenolics division didn't do well. They saw high impact of high-cost inventory in Q2. However, margin improvement is expected in Q3 over Q2 now because things are improving. They said that domestic markets for their industry is doing really well. There is some supply issues and some demand concerns as well in the export markets. Customer demand, however, is not impacted by price hikes that the company took because of higher raw material prices. And they spoke about becoming an integrated player, and that's why looking at a 1,500 crore capex in coming 2 to 3 years as well. Lastly, we spoke to them about the Europe Plus One theme. They said it has to play out over a couple of months, and that's when the real impact will be seen. But yes, companies are moving their production out of Europe as far as the chemical space is concerned.
Thank you very much for that. Prakash, your pick of the pack, your thoughts on what the companies have reported, some of them, and what the managements have to tell us, like Deepak Nitrite?
So I think, numbers will always be a mixed bag and softness in numbers for a particular quarter with a validated reason is always a good opportunity according to me. So I would believe that, the likes of Deepak Nitrite, even Deepak Fertilizers, as and when things, get clear in terms of numbers there, and GSFC and the likes of GNFC, all of these, this basket will give you ample opportunity to get in. But Rima, the thing is, chemicals as a space is something that's probably going to have a little bit of softness in quarters given the demand tepidness in Europe. So I would not go overboard in terms of allocating. It's not yet bottomed out to my understanding. It probably happen sometime closer to Feb, March. And that's when you would kind of look at reevaluating this. But they are fairly priced. I mean, the P multiples have always come at a premium because the growth was so secular, and that's missing at this point in time. So I have a little bit of a contra view on chemicals at this point and not jumping in. But definitely very excited to see the softness come in and more realism stepping into the valuations.
All right, Prakash, thank you very much. Good speaking with you. Appreciate you joining in with some of that perspective. Thank you. 300 points on the Nifty. By the way, the small cap index has picked up a little bit. It's got a 0.5% odd gain. Now nowhere close to where it was earlier on. Mid caps are more flatter. But none of it, of course, rubbing off on what the Nifty is doing, which continues very strongly. Rahul Behjal is Senior Fund Manager, Equity at HDFC Asset Management Company. Rahul, great to have you with us here. Rahul runs the HDFC Top 100 Fund. And I think there is a new sort of fund which is coming on as well, and we'll talk about that. Rahul, but what are your thoughts on the market at this point in time? We have had pretty significant price moves last night on the back of softer inflation data, which was the crux of the problem in the first place. Does that take away? I mean, the market here has been doing well, even despite that. We were already at almost new highs. Does it give added impetus or not really? What's your sense?
Yeah, thanks, Prashant. So I think, the market has been in a corrective phase for almost more than a year now. And it's locally and globally, and even other asset classes. I think after this corrective phase, there were two key macro indicators which the market was focusing on. One was to get some direction on the inflation peaking, and the timing of that, and when would one start looking at a rate cut outlook beginning. And two is the extent of the slowdown that may come in the West. So I think on the first front, you got some clarity yesterday. It looks like that, there is some visibility on the inflation peaking and therefore some visibility on the Fed pivot happening. And I think that's why you've seen some sort of a risk on emerging on the first front. I think on the second front, there is still more clarity, which will come with time. But clearly after yesterday, one leg of the risk off seems to have some sort of a, risk on coming in.
All right, Rahul. Always a pleasure speaking with you. Let's talk about the new fund offer that you have right now. It's called a business cycle fund, where you will obviously look at companies which are more favorable where you know, there are benefits of this cyclicality, so to say, and avoid companies which will obviously, you know, are looking at a down cycle when it comes to business. In your experience, currently where the world is poised, what do you think are the spaces where the business cycle is more favorable, and which are the ones that you would avoid?
Sure. So I think if I look at India, there are a lot of business cycles in favor, and more local cycles than linked to the export market, where you know the risk of growth slowdown is ahead. And within India, if I look at the multiple business cycles which are looking good, clearly banking is one area where we're seeing growth picking up. Asset quality issues are behind, and they're well capitalized, and you can see it in the quarterly results coming out as well. So banking is in a multi-year up cycle. Secondly, the private sector capex cycle, which had a long downturn till 2020-21, is seeing signs of pickup across various sectors, and we're getting good feedback on brownfield capex picking up from the banks, from the various companies we talk to. So clearly, early stage of a multi-year upturn over there. Thirdly, the real estate cycle. Again, India had a long slowdown, almost a 7-year slowdown from 13 to 20. And during COVID times and the last 1.5 years, we are seeing clearly consumers coming back in the top 10, 15 cities, and even in deeper India in terms of purchasing flats for consumption. So I think that's an area which is picking up. And then there are secular upcycles, you know, which have been going on for some time. Specialty chemicals, I think with China plus one, still you have headroom for the next 5-7 years to grow. So clearly, these are 4 areas where, you know, I see strong upcycles. And then there are pockets in the smaller segments like hotels and hospitals, which also offer potential for upcycles to continue.
Rahul, afternoon. At what stage of the upcycle are we in all these identified areas of opportunity for you, whether it's real estate, private cycle? Because markets have done well. All the sectors identified by you have done very well. We are pretty much at all-time high levels. Valuations in many of them are very excessive. So, you know, fair enough. These are all cyclical businesses and they're doing well. Just wanted to understand at what stage are we in currently for each of them?
Sure. So if you look at typically duration of business upcycles, the range varies anywhere between from 3 to 5 years. Sometimes they are shorter as well, as less as 1 or 2 years. So it's an entire gamut of duration which you get to play when you're playing business cycles. Some of the cycles I mentioned, for example, the real estate cycle and the private sector capex cycle, these are typically long duration cycles. You have long duration downturns from which we are coming out, like I mentioned. And typically, once the upturn begins, you have long duration upturns as well. Similarly, the banking cycle, again, you know, is also a long duration one. So I think we are still in the second year of the banking upturn, and you know, you still got, I think, at least 2-3 years good to go. And then you have other cycles which I mentioned. Some of them could be shorter in nature also, and therefore, you know, the call will be taken accordingly. So I think the beauty of this product is that you get a portfolio of companies which are looking good from a business upcycle perspective, and you avoid the companies which are in a down cycle or about to enter a down cycle. And you're constantly evaluating the positioning of these various businesses and the companies in the various cycles. And 2 years later, you may find a different set of cycles which are looking better. And accordingly, you know, realignment of portfolios can be done. So you get a dynamic allocation of stocks across cycles which are looking good. And it's a very agile portfolio. And therefore, you know, I think it's a good product.
Just one follow-up question. The market cycle often precedes the fundamental cycles. We very often see the markets peaking out, hitting a high, well, you know, before things turn, you know, start turning south from the real economy point of view. So in that context, if many of these cycles are in their second year, do you not get a sense that perhaps markets today have already priced in a lot of the good news?
So, you know, I think in terms of valuations and market cycle and business cycles, one has to keep, the perspective clear. I think this particular product is going to focus on timing of the business cycles and building a portfolio of business cycles which are looking good. And it'll be a blend of both secular stocks, which are in the midst of an upcycle, as well as cyclical stocks, which are on the cusp of another business upcycle. So the focus is on timing of the business cycles and not timing the market. So this is a product which is fairly independent of the market cycle, and it's fairly independent of the economic cycle. Sometimes the economy grows at above par, sometimes below par. So we are focusing on business cycles which happen at a subsector level, and therefore I would say timing from a market cycle perspective is not an issue with this product.
Right, and just wanted to understand what would the average duration of holding in a fund like yours be? I mean, how quickly do you decide whether one should be in a certain cycle or one shouldn't? And at the same time, a lot of people say that the leader of a down cycle is still better than a laggard in an up cycle. I mean, what are your thoughts in that?
Sure. So, like I said, the duration of these upturns vary. It could be as short as 1 year to as long as 5 to 7 years, and some will fall somewhere in the middle. So we have a process in place. Our analyst team is very strong, very robust, with WorkX over 20 years, and they've tracked these sectors and cycles over the last 2 decades. So I think there's a strong team which is going to give quality inputs in terms of positioning of the cycles. And in terms of duration, like I said, there's no fixed time frame. It's an entire range ranging from 1 to 5 years. And the focus has to be in, focusing on the parameters like volume growth, pricing power, competition level, bargaining power in the sector, and keep determining regularly as to what stage of the business cycle that subsector is in, and keep positioning companies accordingly in terms of stock picking in the portfolio. As far as down cycle is concerned, like I said, the fund's mandate is to avoid companies in a down cycle. So whether it's a leader or laggard, you won't find such names in the portfolio, irrespective of the trend of outperformance in the past. The focus will remain singularly on companies and businesses in which there is high visibility in terms of the upcycle continuing or the inflection point coming.
Interesting, NF4. Thank you very much, Rahul, for joining us and explaining that, and all the very best to you. Need to take a short break, but as always, when we return, we'll get you a check on what dealing rooms are saying in our segment, D Street Chatter.
Well, holding on with almost 320 points on the Nifty, we have the Nifty Bank, which is the star of the show. The mid-caps not doing particularly well, but a couple of them are actually spiking as we speak. We have NBCC from the broader markets, which is currently your top gainer in the last 15 minutes or so, and it's a vertical rally. We've seen that stock move to the high point of trade. But it is now time for our favorite segment, which is D Street Chatter. Nimesh gets us an insight into dealing rooms. Nimesh, yesterday all the dealing rooms were probably looking at the match, but today the market screen looks a lot more exciting.
Oh yes, it's looking more exciting, but I got a very interesting forward today. I just want to sum up today's market for you. The small caps and mid caps are behaving like the Indian openers, very lethargic, no moves at all. And look at the large cap index, it's playing like a English cricket team. Josh Butler on fire. It's picking out of the park. So that sums up the market for you today. Clearly, it's a global risk on which is helping the Indian markets as well. We are pretty much close to the all-time highs. I guess today's rally is largely large cap driven, right? The HDFC twins, outside of IT, the HDFC twins are helping the bulls. The Reliance is helping the bulls. So that's where the whole traction seems to be. I guess, from a technical point of view, I've been saying this for a while now. 18,300 is a level to watch. On a closing basis, if you end above those levels, we are at those levels. You might see a big gap up on Monday as well. So that's something to watch out. And looks like global markets are supportive as well. So that will be a level to watch from a today's point of view. I guess even in IT, what we're seeing is a large part of the rally is a short covering rally. Most of the investors were short on that particular space. And now you're seeing not only short covering, but some fresh buying as well. So that's helping the IT index as well. But clearly the momentum seems to be with the large cap names. And that's led by the HDFC twins and Reliance in today's trade.
All right, and you've spoken about a lot of stocks, a lot of individual stocks as well. You have on your list today?
Yes, sir. In terms of individual names, the first stock on my radar today is Kotak Mahindra Bank. That stock, off late, they are seeing quite a bit of high delivery. Well, the stock is down today, but what I understand from sources, there is good amount of buying interest back from the larger FIs. So today, there are multiple buyers at some large institutional desks. So that's Kotak Mahindra Bank to watch out for. The second stock is Macrotech Developers. Again, this is one stock post quarter two earnings has been consolidating in this particular range for a while now. Now the indication is that maybe the selling pressure from a large FIS seems to be over, and some domestic funds and HNIs have bought off late. So Macrotech Developers is largely in focus of selling pressure getting over from a larger FII. The third stock is PB Fintech. All of a sudden in the last half an hour, we're seeing a big uptake in that stock as well today. There was a large block in the morning. Remember the lock-in opened yesterday, and today morning we saw a big 3% equity changing hands. The feedback is that a large US-based fund was a seller and some domestic mutual funds bought, but there was a slippage as well, is what I understand. So a lot of stock got slipped into the retail hands, so that's something to watch out. And the last stock is Zomato. Again, part of that platform company is doing good today, up 13%. There is good amount of buying interest as well on the back of strong quarter numbers. But again, a bit of a hint and a warning signal that maybe you'll see a large block in Zomato as well in the near future. So that's something to watch out for. But today, there's good amount of buying interest in Zomato as well.
All right, PB Fintech, Zomato, all of them doing well. Nimesh, finally, before we let you go, it's a Friday today. Usually, you would have perhaps, watched the match on Sunday. But now that India's out, what are your plans for Sunday?
No plans, yeah. Just have to work and all. That's it. No plans. Actually, I haven't planned anything for this weekend.
All right, no one had, but now we have to go ahead and plan because now that India is out of the World Cup. But Rima, back to you.
Okay, and another stock where you could watch for some selling next week will be Paytm, because I think the pre-lock-in expires on 15th of November for Paytm. So that's another one you should keep on your radar next week. But Mitesh Thakkar is still with us. He's going to tell us what you can buy today that you can sell on Monday or a reverse trade. Mitesh?
Yeah. I think IT remains a very simple thing to pick up. I think after a good time, we are seeing strong momentum. The stocks are closing with strength. So Infi, I think disclaimer that I have it in my long-term portfolio. Infi is a BTST with a stop at 1560 and look for targets of 1585, 1590 for tomorrow. Similarly, HCL Tech is a BTST as well. Keep a stop at 1080 for targets of 1105.
Okay, all right. Thanks very much, Mitesh. Those are near-term trading ideas. Siddharth Bhamre is with us, Head of Research at Religare Stockbroking. Siddharth, good to have you back on the program. Thank you very much. So we get follow-through, maybe. I mean, at least right now, you look at U.S. equity futures, you look at the dollar. It's all going in the right direction, so as to speak. So maybe more gains ahead. How are you looking at things near-term?
Hi, Prashant. Thanks for having me on your show. Prashant, we have been optimistic on markets since quite some time. And, we have been talking that despite high inflations, despite stronger dollar index, our markets were buy because of the domestic consumption theme. And the way there was too much of pessimism, I think most of the people, if you just look back, a week back or 2 weeks back and check on, social platforms or your channel, a lot of people would talk about recession. A lot of people would talk about slowdown and how big correction is coming. And I think this is the nature of market, that at 18,000 people will talk about 15-20% upside, and at 16,000 they will talk about 13,000, 12,000. So we don't follow that way of predicting markets. We have been optimistic around 16,000 odd levels, 15,500. 18,000 to 18,500, I believe, would be kind of levels where we might see, some respite in this market, or we might see, some supply coming into this market. And why I'm saying that, Prashant, yes, there is a downtick in US inflation, and that is cheering this market. That's the reason dollar index has fallen, and yields are also, correcting a bit. But let's not forget the fact that many economists believe, and we too feel so, that Fed is probably overshooting, and the repercussions of that would be felt once you start seeing the job data coming out. So rather than getting excited by seeing the CPI data, we won't go too optimistic on this market, because when CPI data was not good, we were looking at jobs data and being excited. So now when CPI data is turning favorable, we are just hoping that job data doesn't turns unfavorable, because if that turns unfavorable, then all these gains would be like probably 1 or 2 days gains, and you might see a correction happening. even if I have to wear my old hat of technicals and see that this market is consolidating since last 1 year, Prashant. And now we are on the upper side of the range where 18,000, 18,500 we have seen supply, around 15,000, 15,500 we have seen buying interest emerging, and these range has been breached on the both sides, and again market has fallen into this range. We are at the upper band of this range, and we won't be too excited about this market, though structurally the domestic consumption story and India is a better place to be. That story remains, but at a price not at any levels.
Siddharth, good hearing your thoughts in, but market, same time last year when we were at 18,000 looked so different in terms of what was driving it, right? There was no inflation concern globally. IT stocks were doing very well. Banks were underperformers. Now, circa 1 year forward, the Nifty is still at the same levels, but the markets have been concerned about inflation through the year. There was a war in Russia, Ukraine, and now banks have taken the front seat while IT stocks have been battered. So same levels, but the market texture, what's driving the market has changed so much in the last 1 year. We need to get into a very short break. We'll come back and continue our conversation with Siddharth, so stay tuned.
Okay, welcome back. So the market is, 7 minutes away from sort of close for the day, close for the week, and it's a super day once again on the index so far. Let me just see what the gains at this rate are going to be for the week. Actually, it's going to be 1 1/3% higher for the week because we had trouble earlier, especially yesterday with that 2.5% cut that we saw. Well, we spoke with Jahangir Aziz earlier today. He's, of course, the top economist at JP Morgan. And he's actually saying, hold your horses. Don't extrapolate the inflation beat and the consequent market reaction many months into the future. It's just 1 month. So that's some important opinion coming in. Take a listen.
The market clearly reacted to the fact that the core inflation was lower than what was expected. And that sort of reinforced the idea that the door to a step down in Fed rate hike in December would be open. Remember, the Fed said that if the data supports, they would step it down. But one needs to remember in all of this, euphoria, one needs to remember that the non-farm payroll just 2 weeks back was actually stronger than expected. The labor market is slowing, but not slowing as quickly as the Fed would like. I think in the US, clearly we haven't peaked. There's a long way to go. And I think in the case of India, I think the task is much harder. It is very difficult to see that the dollar has actually peaked. Most likely the peak is still ahead of us. We will go through these bumps, but clearly the level of dollar where the dollar can go is the peak of the dollar is still ahead of us. And given the fact that the peak of dollar is ahead of us, and given the fact that, as I pointed out, India does not provide enough amount of compensation for the very significant macro risk, given the size of the current account deficit, size of the fiscal deficit, and the inflation, it is very hard to see that the rupee actually is bottoming out at these levels and starting to appreciate.
That's some global opinion. Siddharth, you sounded cautious in the markets. Don't see a case for further upside from here on. In terms of sectoral approach, what would be the best way? And do you see downside or just marking time around this 18,000 level?
No, what I meant is that you may not see a significant upside from here, and you can probably see a decent downside from here, or maybe a prolonged period of consolidation. 200, 300 points here and there. We touch new highs, or maybe we go to 8,700, 800. That's not a substantial upside for people who have time horizon of 6 months to 1 year. So if there is a dip, say maybe towards 17,500, 17,000, that is where, probably again the case can be built for investment scenario. That is what I meant when I say that I'm not very optimistic from current levels. If I have to, talk about sectors which we are liking, then obviously we would, go more from a domestic theme perspective, and we are seeing a decent traction happening in cement space. Not all numbers which came, in this quarter were very encouraging. So, like from our coverage, Ramco Cement disappointed, but there were names like Dalmia and Ultratech Cement which have done pretty well. I think story by now is known to all that how capacity expansion is going to take place in next 2-3 years, how the power cost, which has been very high, which led to deterioration in margins, would now act in the opposite direction, and margins would improve. How green energy is something which these guys are planning to use over a period of time. So that is one space. Ultratech and Dalmia Bharat is something which we are liking. Auto names, you look at the kind of new cars which you are seeing on road, but let's not forget that still the purchasing power of Indians are not very high, and now we are liking something which has not done well in last 5 years, which is Maruti. Market share had gone down from 52 to 43%. But now what we are seeing is it's not doing too much of innovation in terms of new models, but it is launching its existing models in different avatar, like Alto or Swift in CNG, and that is where we believe that there would be a lot of traction which this company would get. Maybe not the old glory would be back, but there would be certainly increase in market share from current levels. So that is one stock where we have recently upgraded our target price, and we are anticipating decent upside. There are, various names in FMCG also which we are liking, but we can talk about that some other time.
No, absolutely. We'd love to, Siddharth. We're just running into market closing, so we'll leave it there for now. But got your point. Appreciate you joining in and hope to see more of you here on the program. Well, we got about 330 points and just 2 minutes to close. So let me quickly wrap up things. We got the Nifty, which of course is going to go home with mostly all gains intact. Actually, gains that it started with and added on during the course of the day. Bank Nifty ends higher, but in the middle of the day's range. So it's more of a mixed picture there. The large contribution, of course, came in from HDFC and HDFC Bank. Between them, I think, a very large amount of gains. And technology as a sector rallied hard. So, I'm just not even going into broader tech names, but Infi, HCL Tech, the large caps, Tech Mahindra, TCS, Wipro, all in the region of between 2 and 4.5% is what we saw. That's the large cap picture for you. Rima.
Well, the mid-cap index closes flat, losing more than 1.5% from the day's high or from the opening tick. The advanced decline ratio, though mildly in favor of the gaining side. The new kid in the block, DCX Systems, has had a stellar listing and finally goes home with a gain of 48%. The issue price was 207. Compared to that, the stock's last tick is closer to 307. New age tech IPO companies are higher in trade. Zomato, after they indicated that the adjusted EBITDA would turn break-even in the next 2 to 4 quarters, saw buying stock up 13.5%. Nykaa too higher by nearly 10%. PB Fintech spurted in the last 30 minutes of trade. Apart from that, a lot of strength coming through in many of these IT names. So First Source was up close to about 6%. eClerx too reacting to a good set of earnings. On the losing side, weakness seen in Campus Active on very large volume. Stock was down 10.5%. GNFC too, weak set of earnings, stock lower. You had cuts from a couple of the other names like Concord, Chambal Fert as well, Mangalam.
Yes, we did. And, to sum things up, it would perhaps be a red letter day irrespective of the way the markets close today, because the Nifty is at a fresh closing high. And a lot of the portfolios, though, would not be as happy as the frontline indices. That's because we end the day with almost an even keel with regards to advanced decline. Nearly 1,500 stocks advancing for 1,300 stocks declining. And the stock of the day on the downside definitely for me was Indian Hotels, despite a decent set of numbers, down almost 6.5% odd. And on the way up, we did see some gains come by for a lot of these mid-cap IT names, giving company to the large cap names. But I also saw Godrej Properties, after the commentary that came in from the management, the stock's done extremely well. It ended well in today's trading session. We end the mid-cap index absolutely flat, even as the Nifty has gained almost 330 points, almost 2%, and ends at a fresh closing high. With that, we wrap up on this edition of Closing Bell, but you don't go anywhere because our Friday special Smart Money comes up right after this shot.